Hello, I'm Patrick South, Vice President of Development at the Chamber of Digital Commerce. For those of you that are unfamiliar with the Chamber, we're a nonprofit trade association focused on promoting the acceptance and use of digital assets and blockchain-based technologies. You can learn more about us on our website at digitalchamber.org or by contacting me, patrick@digitalchamber.org. It's difficult to ignore the increased client interest in digital assets given the global macro backdrop today. However, financial advisors face many questions when considering portfolio allocations towards digital assets. We're thrilled to have you join us for the first event of this three-part educational series around digital assets geared towards financial advisors. This series will run once a week at this time for the next 3 weeks. In today's session, we have a really impressive group of industry leaders who will examine factors such as regulatory tailwinds, increased institutional allocation, and global macro trends to explain why now is a great time to focus on digital assets as a necessary diversification tool. If you have questions, I encourage you to use the Q&A function, and our speakers will try to address them throughout their comments. With that, I'll get out of the way and turn it over to Brian Estes, CIO and Managing Partner at Off the Chain Capital.
Thank you, Patrick. I appreciate that. So before we get started and jump right into why now, I think it's important that we talk about a little bit of the background and what gives digital assets what makes them important in as part of a portfolio diversification tool. Like Patrick said, my name is Brian Estes. I'm gonna be your moderator for the discussion, and I'm gonna allow each of the panelists to introduce themselves. If you want to go ahead and start. Yassine, you want to kick it off?
Absolutely. Thank you guys for having me. It's great to be on. My name is Yassine Almandra. I cover crypto assets and blockchain at ARK Invest. I joined in July of 2018. ARK Invest is a disruptive innovation asset manager. We gained our first exposure to Bitcoin in 2015, and since have been strong advocates of the opportunity. Increasingly, we think that Bitcoin in particular merits an exclusive slice in a traditional portfolio, and we're starting to see a tipping point in the interest from institutions to consider that. So it's great to be here and excited for this panel.
Matthew, you want to go next?
Sure, yeah. Matt Hogan, really glad to be here as well. I'm the Global Head of Research for Bitwise Asset Management. Bitwise is best known for creating the first and today running the largest crypto index fund in the world, the Bitwise 10. We're focused exclusively on the financial advisor market. A lot of us come out of the ETF industry. I myself was the CEO of ETF.com and Inside ETFs for 15 years before joining Bitwise in 2017. So really excited to be here today to talk about financial advisors moving into crypto.
Okay, and Sunanya, you want to go?
Sure, thank you, Brian. And just want to extend thank you to Patrick and the Digital Chamber for finding the art of the possible and bringing us together for this series. It's a nice pivot from all the binge watching we've been doing to perhaps a little bit of binge learning. So thank you guys. And good to be among so many friends and all the crypto savants on this panel. As mentioned, my name is Sunanya. I'm the Managing Director and Global Head of Digital Assets and Blockchain at TD Ameritrade. Prior to this, I was our Global Head of Emerging Tech and Strategic Partnership, always operating at this nexus of finance, tech, and policy, really with this underlying obsession of how do we tap into the power of new technologies, but in a way that helps us break down barriers that continue to persist in financial services. And at TD Ameritrade, for us leaning into both blockchain, the tech, and Bitcoin, the digital assets, was a nice continuity of really the ethos of the firm, which was founded on this mission of bringing Wall Street to Main Street and empowering everyday investors to take charge of their financial future. And really what my team and I are focused on is, how do you bring access to this asset class to the individual investors and to the RIA community, and happy to double click into that throughout the session.
Okay, and last but not least is RIA.
Thanks, Brian. And thank you so much for having us all. It's great to be here. As Sunanya said, with some of are close friends from in the crypto space. So I'm Ria. I'm director of research at Fidelity Digital Assets. I've been there for about a year now. I just had my 1-year anniversary a couple weeks ago. So Fidelity Digital Assets is a Bitcoin custody. Well, right now we provide custody and trade execution services for Bitcoin, specifically to institutional investors in crypto and in traditional markets. Fidelity itself has been exploring Bitcoin and digital assets since about 2014, 2015. And Fidelity Digital Assets is the first business that was launched out of that effort.
Great. Okay, so let's dig in. So before we talk about why digital assets now, we need to clarify some of the misconceptions and give a little bit of background. So Yassine, let's discuss some of the myths about Bitcoin. You know, there's all sorts of myths, like mining consumes too much energy, it's linked to criminal activity, you know, Bitcoin's not backed by anything, there's no intrinsic value there, or Bitcoin and cryptocurrencies exchanges are easily hacked. Do you want to try to dispel some of these myths that are out there?
Absolutely. I think that this question is actually consistent with some of the research that we conducted a few months ago in light of the Goldman Sachs leaked presentation on their stance on Bitcoin, where they basically said that it wasn't a worthy asset as an investment. And the rationale that they gave seemed to trigger the crypto community just because of how, I would say, outdated or stale the arguments were. So, there is still, part of the reason why Bitcoin is still struggling to gain widespread institutional acceptance is really from kind of a lack of basic understanding of Bitcoin's value propositions. So you mentioned a few, and we can, we briefly go through them. One of Bitcoin's most common critiques is that it wastes too much energy. Critics often assert that the whole idea of proof of work mining, it basically consumes more resources than the benefits that it creates. And the Bitcoin community would respond to that by saying that, what critics might deem as computationally inefficient is not only an intended trade-off, but a fundamental feature, right? The idea of having sort of prolific resource consumption and quote unquote poor computational scalability unlocks the security necessary for an independent, seamless, global sort of monetary system. And so what Bitcoin does is it makes that explicit trade-off where it allocates significant real-world resources to mining, and in return can guarantee network settlement like no other settlement network. And so the idea of having sort of dedicated hardware that proves costly computation is a fundamental feature. Even when you look at sort of the energy footprint of Bitcoin relative to traditional banks and, let's call it gold, it consumes far less than traditional financial systems. Another common critique that we see is Bitcoin is for criminals. It's kind of focused on terrorists and drug lords and and drug trafficking. I think that the response there is that to criticize Bitcoin for facilitating criminal activity is really to criticize one of its fundamental value propositions in censorship resistance. The idea that Bitcoin is a neutral technology is fundamental to why it works so well, and it can't really identify sort of who is criminal or what activity is malicious. And so if a criminal activity can be censored on the Bitcoin network, then all activity can be censored. And this doesn't necessarily make Bitcoin an inherently criminal tool, just like phones or cars or internet are no less bannable for facilitating criminal activity. Kind of Bitcoin is in that same spirit. And then I'll just finish off with the last two, where Bitcoin, we see a lot of exchange hacks. I think simply they're criticizing Bitcoin for exchange hacks is akin to criticizing the US dollar for a bank robbery, right? If we see some robber go into a bank, are we going to blame the US dollar for that robbery, or are we going to blame sort of the infrastructure around it? And then finally, sort of my favorite, which is sort of Bitcoin has no intrinsic value. It's in a bubble. It's dependent on speculation, like a game of hot potato. I think this really sort of dismisses the reason why Bitcoin accrues value over time. true. It doesn't sort of behave like a traditional investable asset, but as a monetary asset that is non-productive, it has specific sort of monetary properties that drive demand. And while that's sort of circular, a monetary asset might appreciate as more people demand it, and more people demand it if it's an effective monetary asset. The reason why Bitcoin is so attractive today is because of the specific monetary characteristics that drive demand for it. And so we often call Bitcoin digital gold because it shares and improves upon a lot of gold's characteristics. It's scarce, it's durable, it's verifiable, it's portable, it's transferable, all which drive it to create sort of a superior utility and to that sort of role as a digital global money. So these are some of the kind of common myths that we see that we like to debunk.
That's great. And Sunanya, would you like to add to that?
Yeah, I think building on what Yassine said, and maybe I'll take the the vantage point of the constituents that we work with, that range from regulators to the board to, our clients, the individual investors in the RIA. And I would say they all kind of span the spectrum of, there are many who are very crypto savvy already. And I would say the large bucket is crypto curious, where, maybe they've heard some of these misconceptions, but they're willing to learn and, kind of up their crypto quotient, perhaps. And then there's always that bucket of, skeptics. And in fact, one of my favorite conversations is with the skeptics and kind of handling the fact versus FUD conversation. And the two that I'll share that we hear often, and, as I tell my skeptical friends, it's okay to be skeptic, but it's no longer kosher to be apathetic, right? You got to be leaning in and learning and formulating kind of own point of view. The two that, we talk a lot about, one is, it's only for the kids, right? Like, what really is the business case for organizations like ours that have so many other priorities and things to do? Why would we lean in? And, we all work with finite amount of, time, capital, talent. Why take something away and, devote to this? And my answer to that is, sure, at the onset, maybe, the segments that were attracted to Bitcoin and digital assets at large maybe skewed younger, the millennials, the kids. But the kids are having their own kids, the millennials, and aren't that young anymore. But what we're also seeing that it's now starting to cut across demographics, that it's the kids, but they're also bringing their parents and grandparents along. No different than what we saw with social media adoption, that perhaps the kids embraced it first, and then their parents kind of join in, and the kids go find something else. So there's definitely that cut across demographics. So the segments are expanding, which means your overall addressable market is starting to expand, and you can't afford to kind of sit it out. The other thing I would share, given our audience of advisors today, is even if it is that the broadest segment engaged with this asset class are skewing younger, it's important to know that there is a massive, generational transfer of wealth that's happening, which is only going to be accelerated in years, in upcoming years, and it's in trillions and trillions of dollars, right? And the way that the recipients of this generational wealth are going to engage with their advisors and the asset class that they're going to be interested in isn't going to be the same as their parents or grandparents. And in a way, we all have to skate to where the puck is going. Sorry, I'm Canadian. I gotta, put in a plug for Gretzky there, and kind of go where the clients are going. So that's one. The second one we hear often is, well, what about the volatility, right? Like, it yo-yos and it's up and down. How do I even keep track? A couple of things I would say. One is, when it comes to digital assets, and let's focus on Bitcoin, I would submit that, volatility is a feature, not a bug. And many people, many market participants who are coming into digital assets, they actually want the volatility. And on the other side of the coin, what I would share is the volatility that Bitcoin has seen is no different than what we've experienced with traditional asset classes, especially in 2020. And we've done a lot of research that kind of compares and contrasts the type of volatility we see with FANG stocks, which our clients love to hold and trade, and compared it to Bitcoin. And in many instances, there are FANG stocks that will beat, Bitcoin when it comes to volatility. So it's a feature and an asset, but two, it's actually pretty analogous to what consumers are accustomed to with traditional asset classes.
Great. And I'm going to keep you rolling, so I might have a follow-up question for you. So Brian Brooks, who's the comptroller of the U.S. currency, he was on CNN about a month ago, and he said, I think it was 55 million Americans own cryptocurrency today. So that's about 15% of US households. So what do you think is going to enable, or what do you think is preventing from the other 85% of US households from investing in digital assets? And how do you see that changing in the future?
Yeah, really impressed with what Brian and team at the OCC have been able to do in such a short amount of time in helping to bring more clarity in the regulatory space. So, definitely want to kind of put that out there. I see a couple of things. Number one, and I think the most important from our vantage point, is education and advocacy, right? We've seen throughout the existence of TD Ameritrade with other asset classes that education really is the silver bullet, that an educated investor or an educated advisor is a more empowered investor, and thereby, you could say a more successful investor, and they kind of stick to that journey for the long term. And with digital assets, we believe it's even more paramount, just given the perceived nascency and complexity that kind of shrouds this asset class. And, I think this panel is great. Like, I, as a consumer of the content that Yassine at ARC and Nat and even RIA put out, would kind of say that's a great starting point for people to kind of lean in and again, educate themselves with facts versus, keep away from the hype and the hyperbole, positive or negative, and really ground yourself in some of the facts and education. So I think education will play a huge role. And what we've seen with, even in the segments that we serve, is initially the interest and demand for education and access to digital assets really came from our active traders, which makes a lot of sense. They usually lean into new technologies, they're comfortable with sophisticated asset classes, but very quickly that spread to our individual investors. And I would say 2020 for us has really been the year the RIA, not RIA, but the Registered Investor Advisors, and I think we're at an inflection point, both from a generational transfer of wealth, and they're recognizing the need for this asset class. But I would say this new wave of market participants are perhaps coming into this asset class for reasons that are a little bit different, which is more pragmatic, right? They're looking at it for asset allocation and diversification and hedge against inflation, or the narrative of digital gold that was mentioned earlier. So it's a little bit of a shift, that it's less about the ideology and more about the pragmatic need that's starting to bring new people in. And I'll kind of close with one of my favorite quotes from Hemingway, which kind of goes, it's slowly at first and all at once. And I'm confident that's what we're starting to see with the adoption of digital assets.
That's great. And Matt, like we just talked about, 15% of US households today own cryptocurrency. How do you think we get to 85, 90, 100% in the future?
Yeah, I think that's an interesting question. I actually want to spin it a little bit, right? Because the reality of wealth in America is that most of the wealth is owned by a relatively little number of people, right? 10% of people own 85% of the wealth. The issue with crypto is you have 15% of America that owns it, which are mostly young people with relatively little money. And then you have people who own stocks, and those two Venn diagrams don't overlap. I think what Sunenya said about this being the year of the RIA is the thing that's really going to be the transformational moment in terms of the amount of wealth in America that's allocated to the crypto space, right? Financial advisors control the vast majority of wealth in America. And as they move into the crypto space, it's going to be a massive inflow of money into the space. And so the answer to the question of, what gets the majority of wealth in America allocating to crypto, part of it is education, as mentioned earlier. Some of it is really boring stuff like plumbing. It's still very hard for financial advisors to allocate to crypto. It's not, most financial advisor custodians don't allow crypto funds on their platform. There's still no ETF in the space. But the potential there is simply massive. They control, $20 trillion of wealth in America. It's a huge potential movement. So a lot of it is still plumbing, right? Plumbing was a big part of the story in 2019 with the development of institutional custodians and institutional trading platforms and the further establishments of things like what RIA is working at Fidelity. As it becomes mainstream into the advisor space, the flow of assets is going to be just enormous.
Right. And let's stick with you for one more question. So the Federal Reserve it was the St. Louis Fed to be specific, in January of 2018, came out with a cryptocurrency white paper. And in that white paper, it said that Bitcoin's best use case is as a diversification tool, a portfolio diversification tool, because it's a non-correlated asset.
Yeah.
And when you add a small amount of a non-correlated asset, that has a benefit to a portfolio. And so can you talk about that? Like, why would people want to add digital assets like Bitcoin to their portfolio?
I think it's the ultimate alternative asset. Look, crypto combines three things that are really hard for investors to usually get. It's high potential returns, it's low correlations to other assets, and it's liquidity. And maybe a fourth thing, which is access for most investors. Usually when you're talking about things with high potential returns and low correlations to other assets, you're talking about things like early stage VC. Well, guess what? You and I probably can't invest in Andreessen's latest fund. Most clients of financial advisors don't have access to the top tier of VC, and they can't lock up their funds for 7 to 10 to 12 years. The beautiful thing about crypto is it combines that high potential returns, right? Bitcoin's up 3,000% over the last 5 years. Low correlations to other assets. The correlations to stocks, bonds, gold, et cetera, are all about 0.1, 0.2. And liquidity and access. You and I can buy it just as easily at just as low cost, rebalance it just as frequently as the largest institutions in the world. And the impact of that is enormous, right? We did a big study, it's available on a white paper, the role of crypto in an institutional portfolio. Adding 2.5% allocation to Bitcoin to a 60-40 portfolio has improved that portfolio's returns and risk-adjusted returns over every 3-year period in history. And the impact has been significant, often doubling the returns of that portfolio. It's just an enormously powerful access, and really uniquely, for the first time ever, average investors have the same chance to get exposure to it as the largest institutional investors in the world. It's an enormous equalizer, and it's powerful even in small amounts in a portfolio.
You make a great point about how owning an asset like Bitcoin or digital assets, it levels the playing field. You don't have to have millions of dollars and go to Andreessen Horowitz or some of the top VCs out there. Anyone could buy Bitcoin. RIA, why do you think investors should add Bitcoin or cryptocurrencies to their portfolio?
I echo everything that Matt said, and I highly recommend everyone check out Matt's report. And I know Yassine just did a report as well, kind of demonstrating the upside potential and trying to size Bitcoin's addressable market. So, what I want to talk about is like why, Bitcoin has been uncorrelated. And that's important, looking at the historical data, but it's also important to think about why it's been uncorrelated and why it could continue to be uncorrelated going forward. So going forward, if you think about the pandemic, the impact of central banks, intervention globally at unprecedented levels, Bitcoin is fundamentally uncorrelated to those actions. So, the pandemic and central bank actions will continue to have an impact on pretty much all other asset classes, equities, fixed income, commodities. But Bitcoin is fundamentally detached from that. There's no production to cut, no production disruptions. If you think about even gold was affected earlier this year, I think in March, April, when there was travel bans globally, it impacted the production and transportation of gold, backing futures and other products. And there's no profit losses as a result of customer demand. So, these are things that investors need to be cognizant of when they're thinking about, okay, I'm thinking about recalibrating my portfolio. What asset is fundamentally uncorrelated from all of these events taking place globally? I think another reason for Bitcoin's lack of correlation historically has been that it has these dynamic narratives. So some people think of it as digital gold. Some people think of it as an alternative, purely financial investment. In the early days, people thought of it as a payments tool. It could be a payments tool going forward, but maybe for larger, more substantial global transactions. But I think that lack of agreed upon narrative has been a positive in a way, because it's not correlated to any one single asset that falls under a single narrative. And, you know, so long as it continues to have these dynamic narratives and use cases, it will continue to be uncorrelated with other asset classes. And yeah, like you said, adding an asset that is not even negatively correlated, it's just fundamentally uncorrelated from other assets, has shown to have a positive impact on portfolios.
So you mentioned something a while ago, you compared Bitcoin to gold. So what do you think are the similarities and differences between like Bitcoin and gold as a store of value?
I think, you know, the biggest similarity, which is widely talked about, is the scarcity of Bitcoin and gold. But I think what's unique about Bitcoin versus gold is that Bitcoin is perfectly inelastic. There will only ever be 21 million Bitcoin produced, but whereas for gold, you don't know the exact, or like production can increase as a result of demand to some extent, but that's not true for Bitcoin. I think, you know, a few other differences between Bitcoin and gold. Bitcoin is fully transparent and auditable by anyone, anywhere. That's not true for gold. You know, you have to trust intermediaries to determine how much gold there actually is. You can't verify for yourself how much gold exists at any given point in time. Another massive difference is that Bitcoin is portable. You know, you can take it across borders with your cell phone, a digital ledger. You can't do the same thing with your gold. I know in the past we've talked about, Brian, brain wallets and the ability to, but I know there was some research that came out recently that kind of, by BitMEX research, that poked holes at the viability of brain wallets. But, you know, I think the point there is Bitcoin is a lot more portable than gold. Those are the few differences that I would highlight.
Okay. And Sunanya, would you like to add to that? Or what do you think the differences and similarities are to Bitcoin and gold as a store of value?
I think the rest of the panel covered it, you know, really well. My one addition to the conversation would be, I think it's, you know, it's also just the evolution of consumer preferences, right? You know, we can be very scientific and logical about a lot of these merits, but sometimes, as we've seen again in COVID and other parts of, you know, technology adoption, that, you know, when there is a pain point, and this Bitcoin happens to be the solution. And what's that adage? Solve for painkillers, not for vitamins. And I think Bitcoin is starting to prove out, listen, there's also been a lot of shade thrown at Bitcoin during this crisis around the questions of correlation, why isn't the price going to the moon and all of that. And what I would submit to that argument is, listen, we are all obsessed with Bitcoin and we've been spending all of our time and energy on it. And sometimes we forget we're only in it for about 10 years thus far, right? Like this asset class really had its genesis at the last major global financial crisis. And this is the first time it's really being stress tested. And yes, there are times where, you know, one of the analogies I used in March, April, when the traditional markets were melting down is, you know, the traditional markets, you know, were akin to a toddler throwing tantrums until the Fed came in and gave it the candy it needed. You know, I would say Bitcoin has sometimes been acting like the confused teenager, right? It also is trying to figure out who it is, what it wants to be, he or she, when it grows up. So I think it's evolution. And I think all of those ingredients with everything else that everyone kind of mentioned, it's like this confluence of events, and, you know, the market participants are going to come, and they're going to come for different reasons. I just want to be sure that we're all building an ecosystem that's more of a big tent, and it's kind of making Bitcoin more inviting versus intimidating. And that's partly with education, with infrastructure, you know, and all of those, and regulatory clarity.
That's great. I was at a conference about a year ago, and someone was explaining Bitcoin to a bunch of high schoolers. And this is probably a silly way to explain Bitcoin, but it kind of makes the point that he was making the point that if the internet and gold got married and they had a baby, the baby would be Bitcoin, you know, because it has combinations of both. You know, you need both for Bitcoin to be born. So I just thought that was interesting, but it is silly. Okay, Yassine, let's move on and talk about like why invest in digital assets and Bitcoin today. Like what makes now like imperative or important rather than wait until 10 years from now. So is Bitcoin a good value today? How do we know? Like how do we value Bitcoin? Like we know what the price is. Everyone you could see the price like every minute of the day. But what is the value? How do we know we're getting a good value today if we buy Bitcoin?
Sure. I think that this is also quite consistent with one of the questions that we got in the Q&A, where it's one thing to have an uncorrelated asset, but you need to have an uncorrelated asset with some sort of expected return that's high enough to offset the increase in risk. And so there are a lot of investors that are thinking about, how can we what is a reasonable basis by which we can determine that expected return? That's part of what makes sort of Bitcoin very difficult to understand, is because the traditional institution or the traditional investor is used to having assets that they can very easily reconcile into some sort of value, right? A productive asset like an equity, you have the traditional sort of discounted cash flow model, and you can have some sort of price target on that based on growth, based on return on capital. With Bitcoin, it's a lot different because it is a non-productive asset. And again, value accrual is a function of reservation demand. And while that is circular, there is some sort of opportunity that can be sized, at the very least top down. So in our most recent piece, we sort of looked at the different opportunities that Bitcoin presents for an investor that would ultimately drive demand and increase value. As it pertains to just digital gold, right? If we kind of accept the premise that it is a better version of gold, that there is a shift in consumer preference, that it is indeed going to be the native asset that lives and breathes on the internet. Well, if we look at what that opportunity looks like, if it were just to capture, call it 10% of physical gold's market cap in the next 5 to 10 years, that alone is a $1 trillion opportunity, up from the $200 billion market cap that we see today. Another example is, looking at Bitcoin as this really unseizable asset, right? Where the idea of ownership of an asset in Bitcoin is not reliant on sort of a local enforcer or protector. It's reliant on really hard to break math and cryptography. We mentioned brain wallets. We mentioned the ability to custody assets and port that custody. Bitcoin has introduced a new paradigm for kind of wealth ownership. And if you look at the opportunity that Bitcoin can provide as sort of an insurance policy against arbitrary asset seizure, that is in the multiple trillions of dollars. Another example is looking at Bitcoin as a global settlement network between and amongst banks, or as a catalyst for currency demonetization. So there are a lot of opportunities, all of them additive, all of them positive sum to Bitcoin's to Bitcoin's value, that investors will increasingly realize. Again, RIA mentioned that there are only 21 million Bitcoin. There's a finite number of Bitcoin. That Bitcoin itself is hypothetically infinitely divisible. So as long as there is that new real incremental demand for whatever use case an individual might want, we will see increasing value. So we sort of size the opportunity within the next 5 to 10 years as being between $1 and $5 trillion. And many Bitcoin advocates would consider that to be conservative.
Okay, so you mentioned that there's 21 million Bitcoin that are being created. Someone typed in, they asked a question, well, if the supply of Bitcoin is limited, what prevents other people from creating other versions of Bitcoin, like like Bitcoin Cash, Bitcoin Gold, Bitcoin Diamond, Bitcoin Cash SD? What prevents people from just copying Bitcoin, and why would Bitcoin maintain value if people can just copy it?
It's a great question. It's also a common myth, I'd say. There's this whole idea of Bitcoin loses value because of forks and digital copies. I think the punchline there is Bitcoin's value can't be replicated by software alone. And you can really, the analogy that I like to give for these sorts of questions is kind of forking the Bitcoin network or creating a digital copy of Bitcoin doesn't create new Bitcoin units, much like inflating the Venezuelan bolivar does not add dollars to the US monetary base, right? And so if you're going to create a digital copy, you also need to create a massive network effect behind that digital copy to even compete with Bitcoin. We've seen that with forks like Bitcoin Cash and Bitcoin SV, where the network effects were nowhere near that of Bitcoin, and we kind of have seen the ultimate fate of those forks. In a similar fashion, any competitor to Bitcoin is going to need to have some sort of network effect beyond just, okay, we are a faster, better version. You can also equate the sort of the value of these forks as equating, let's say that I were to give you Facebook source code, right? And you're like, you can have the entire social media platform, you can have access to all of the technological backend, but what about those 2.6 billion users? What about the 50,000 employees? What about the brand and name recognition? So it's very similar to this idea of network effects being the primary value driver for these cryptocurrencies.
Great. And Matt, we've been talking a lot about Bitcoin, but there are 3,000 other cryptocurrencies out there. So Bitwise, actually, your company runs an index of cryptocurrencies. Yep. So the question is like, do we invest in Bitcoin? Do we invest in all the cryptocurrencies? Like, how do you think about that?
Sure. First, I want to add one note on Bitcoin because I don't want people to think I'm anti-Bitcoin. To me, the biggest difference between Bitcoin and gold is the impact it can have on your portfolio. A lot of people out there are trying to hedge their inflation risk by making a small allocation to gold. But even the most bullish gold bulls think it might go from $2,000 to $3,000. If you have a 2% allocation to gold in your portfolio and inflation ravages the world and gold goes up 50%, it's not going to do much. It's like getting a lollipop after the bank forecloses on your house. The beautiful thing about Bitcoin is that potential returns are so large. What Yassine was saying, what Bloomberg put out a note recently calling for $100,000 Bitcoin by 2025. You can have a small allocation without detracting from your core investment portfolio and have an efficient hedge against inflationary risk. And we've been talking to a bunch of endowments who have been supplementing or talking about supplementing their gold allocation as an inflation hedge with a small amount of Bitcoin because it's so much more efficient. So from a portfolio perspective, I think that's a big deal. Now, when you get to, should you own just Bitcoin or all other assets, it really depends on your point of view about what crypto is all about. If your core belief is that the fundamental breakthrough of crypto assets was to create digital scarcity and digital property rights, Bitcoin, I think, has owned that market. The Bitcoin blockchain is optimized for security. It's optimized for decentralization. It's optimized to be censorship resistant. As a couple people on this panel has said, I think it's going to own the digital gold market. My own view of crypto is that blockchains are about more than just digital sovereignty and digital property rights. They also introduced a couple of other primitives into the market. They introduced instantaneous settlement, right? You can settle a crypto transaction in seconds. You could settle thousands of crypto transactions in the same second. They introduced the idea of programmable money and what we're seeing in DeFi. They introduced the idea of moving money into the internet age. And the reality is that the other crypto assets that exist are optimized to do different things. You take Ethereum. Ethereum is less secure than Bitcoin. It has a bigger programming interface. It has more code, but you can program it to do more than Bitcoin. It's more aggressive in its development pathway than Bitcoin. That's why the decentralized finance market is being built on Ethereum and not on Bitcoin. You take XRP, which a lot of people hate. XRP is much more centralized than Bitcoin. The flip side of being much more centralized, it is much faster, right? So you have different crypto assets that are optimized for different use cases. And my own view of crypto and blockchain is that as amazing as digital property rights and digital scarcity is, and I love Bitcoin, I have a big allocation to it. Our fund is 75% Bitcoin. These other ideas of programmable money, of instantaneous settlement, of building other ideas on the top of moving internet money onto the internet age are potentially large as well. The beauty of an index approach, and I'll stop here, is that you don't have to worry which bet is right. If Bitcoin goes on to be the only winner and it's a multi-trillion-dollar market, a market cap weighted index will eventually be all Bitcoin. But if these other markets becomes significant as well. And you just look at what's happening in DeFi, which is, you know, doubling on a monthly basis in some aspects. Then you have exposure to that as well. So I'm optimistic that blockchain, public blockchains represent a fundamental breakthrough with multiple different applications. And that's why I think the index-based approach is the right approach. But Bitcoin only is definitely better than nothing.
Yeah, Scene, do you want to jump in here? And what do you think? Is it Bitcoin only? Is it Bitcoin plus? Or like, how do you think about that?
Yeah, I think Matt summed it up quite well. I think at this stage, it really depends on, yeah, to Matt's point, your view of the market and also your risk appetite. You know, there's a big difference between going from, you know, nothing to Bitcoin than there would be from going from Bitcoin to, you know, Bitcoin and ETH, for example. I think another consideration at this stage is the, you know, correlation amongst crypto assets more broadly, right? We have 3,000 crypto assets, and most of them are highly correlated. So at the very best, they're almost a levered beta play. I think until we see a real decoupling, which we've started to see, then, you know, it might be worth taking that next step of gaining exposure beyond Bitcoin. So really at this question is more of a know your audience, where if you're talking to someone who is barely convinced of Bitcoin, you know, baby steps and saying, okay, we'll just start with Bitcoin. If it's more of, okay, what's the next generation, and how can I kind of potentially outperform Bitcoin, then we might look at, you know, other assets. So, you know, particularly in the context of these assets as investments. And then one other thing I'll add as well, in the context of making investments, is I think that, you know, diversification in the crypto space, I think, is more of a luxury than what we might see in the equity space. You know, when you look at kind of the value accrual dynamics of these non-productive assets, I tend to think it's still a winner take most game, just because of, again, the importance of network effects. In some ways, it doesn't really make sense to be contrarian when it comes to a digital gold, right? You want what everyone else has. You want the most liquid, the most recognizable. Now, the question is, are there use cases beyond that? To Matt's point around settlement, around programmable money, around creating decentralized kind of financial applications? Absolutely. And I think that we're starting to see increased usage. Whether that translates to a worthy investment, you know, it's really a question of time that will tell.
So RIA, you put out some great research reports about Bitcoin over the past few months through Fidelity Digital Assets. And in your reports, you talk about, you know, Bitcoin being one of the best performing asset classes. And if you look at Bitcoin as an asset class, 9 out of the past 11 years, Bitcoin's been the best performing asset class. It's been better than large cap stocks, you know, small caps, REITs, international stocks, emerging markets. And I was just wondering, like, how do you think about that? Like, why don't you think more people know and more RAs don't know about, like, Bitcoin being, as, you know, one of the top performing asset classes?
Sure. Let me start off by saying why I think it's been one of the best performing asset classes of the last 9 out of the last 11 years. You know, it's a 0 to 1 innovation. It is the first time we've been able to achieve digital scarcity on the internet. And, you know, with each cycle, more and more people are educating themselves and learning about, like, I would even say, limitless potential of Bitcoin. You know, if people think about it as a store of value and compare it to gold, which currently has an $8 to $11 trillion market cap, and there's so many other stores of value that you could use to create a total addressable market for Bitcoin. So, you know, I think that's the 0 to 1 innovation is one of the key reasons that it has been one of the best performing asset classes or assets of the 9 out of the last 11 years. And it's also growing. It grew off a really small base, right? It started at 0 when it was introduced back in 2009. So the growth truly has been exponential. Why don't I think that, you know, a lot of institutions don't realize this? I think in the early days, it was because it started off as a retail asset, right? All the infrastructure that was built initially for Bitcoin was built for retail investors. And only in the last 2 to 3 years have we started to see the flourishing of infrastructure that's really built for institutional investors. And I think it's also a function of the fact that the circles in which people learned about Bitcoin were also non-traditional, right? Like it was Twitter, it was Telegram, it was Bitcoin forums on the internet, and these are not institutional channels. And I think media coverage of Bitcoin has also grown a lot more in recent years, and that's why I don't think a lot of institutional investors or RIAs or financial advisors realize until now. I think they're starting to realize now that it has been one of the best performing assets.
Mm-hmm. Yeah. And Sunanya, what do you think? Why do you think financial advisors haven't come to grips with Bitcoin is the best performing asset class 9 out of 11 years, or they're almost in denial, like they don't want to believe it. So what do you think is preventing these advisors from adopting Bitcoin as an asset class?
Yeah, so I think looking at it from the client's eyes and specifically the advisors in this scenario, I think it's a combination of as you said, awareness and adoption. I think we've all talked at length during this session that the awareness is definitely going up and to the right and will continue to, and that's great. And there's a lot of tailwinds driving that, right? I think in terms of adoption specifically for the advisor community, listen, as bullish and enthusiastic as I am about Bitcoin and having been in the rabbit hole since 2012 personally, I'm equally, balanced in terms of the recognition that we have to proceed with prudence and pragmatism, right? And I'm very empathetic, that for the advisors and for all of us here, that this is operationalizing this is not easy, right? But it is getting easier, and we've come a long way in the last few years. And I think that will just compound and make things easier. I think from an advisor perspective, there's a couple things I think are kind of maybe holding back the adoption, but I think we'll get there. I think one is, the availability of the diversity of on-ramps and instruments, right? And think about it, just in the last 4 years, when the last Bitcoin halving happened, there was no such thing as a derivatives market. And this year around the halving, a lot of the conversations was around what will the impact of things like Bitcoin futures have on, the outcome of the halving, right? So, very quickly we're seeing new on-ramps and instruments kind of come online, which I think is excellent because whether a client or an advisor wants to engage with this asset class with a managed product or spot or, derivatives, that's not our choice to make. Our job is to bring online as many of those on-ramps and instruments that makes access and adoption easy. So that's what. I think the second thing is around operational risk, right? I compare it to the analogy of, you're flying a plane while writing the flight manual, which can kind of seem rather adventurous, but that's really been the journey for a lot of us who kind of leaned into it early on. But now there is more of a playbook that the advisors can utilize and, kind of figure out how to integrate into their business. I think one of the great things that Square just did this week, I think it's this week, it's all a blur, is not just that they announced that they're adding Bitcoin to their balance sheet, but they put out a bit of a playbook on how they went about it, so other publicly traded companies can kind of say, oh, great, I can kind of leverage that. And that sounds like a simple thing, but it goes a long way in terms of operationalizing something that can, seem, too novel. The last one that I would share is, let's not minimize the fact that there has been regulatory risk. I live in the Valley and it sounds rather quaint, but, we are in the business of asking for permission, not forgiveness. And I think that advisors will relate to it. Ultimately, you are in the trust business. Your clients have, given you not just their money, but they're trusting you with their financial future and just their overall future. And, so I think, not having regulatory clarity has held people back. But again, we're seeing that tide change with the work that's coming out of the CFTC, SEC, and OCC, as you mentioned. My one recommendation to the advisors who are leaning into it would be bring your BFFs from compliance and legal and risk early on as you're formulating your strategy and developing your approach, so that they can help you get there in a way that's scalable and sustainable. And the last, and others can kind of chime in on this, is until now, there has been a significant career risk, right? When I got into Bitcoin in 2012, I never fathomed, I was working in investment banking, so I couldn't really tell anybody at work that I was into this thing called Bitcoin. I never thought that one day this would be the job I would lead. And, that's all happened in a matter of few years, which is very exciting. And as you see marquee brands like Fidelity and the work that Matt and Ark and Yassine are doing, or, when we see a macro, Wall Street veteran like Paul Tudor Jones kind of come out and vocalize his support, or publicly traded companies like Square announce their commitment, I think that starts to remove that career risk, so that more people within their organizations as advisors and others can really say, hey, we ought to do this, and we ought to do this now, and kind of, use all of these individuals and brands as cover to kind of start to lean into it. So yes, it's been slow and steady, but, as I said earlier, slowly at first, then all at once.
So Matt, I want to jump back to you. This is more of a macro question, kind of fits in your wheelhouse. So the Federal Reserve has been printing a lot, creating a lot of US dollars over the past year because of COVID and what's going on with the economy. How do you think, what are the consequences of the Fed creating, more and more currency like that? How does that affect Bitcoin?
Yeah, well, I think the consequences are pretty clear. And it's not maybe what you think. A lot of people think when I say that, I'm going to say that the consequence is going to be runaway inflation and a destruction of the value of the dollar, and therefore an inflation of assets that provide a hedge to that, like Bitcoin. That's not quite right. I think what's happened is the tails have fattened on the inflation deflationary outcome. Mm-hmm. We could see the likelihood that we see significant inflation has expanded dramatically. The Fed balance sheet has doubled in the past year, right? It took 200 years to get to size A, and then it doubled in a year. The federal deficit has gone from $1 trillion to $4 trillion, likely to expand more post-election. We don't know what the outcome is or the time frame on which that's going to happen, but what we do know is that the tails have gotten a lot fatter. And as the tails get fatter, the necessity and importance of hedging that risk grows. And you can see assets like Bitcoin, the price can go up in anticipation of that risk arriving as people put those hedges on, right? So scarce assets, whether that's gold or Bitcoin, will respond to that by attracting more investment. And I think that's what you're seeing. That's not the only reason Bitcoin has gone up substantially this year, but it is a big reason, right? Think about Paul Tudor Jones, think about Michael Saylor. The reason those people are investing is exactly this. They're worried about the tail risk on the value of the US dollar, and they're finding that Bitcoin is the fastest horse, or whatever the evocative phrase that Paul Tudor Jones used. So it's necessarily beneficial, and I think it's an important part of portfolio management as we go into the future.
Anyone else want to add to that? No? Okay, so we're getting close to the end. What I'd like to do, the last question is, how do people get involved? If you want to gain exposure to cryptocurrencies or Bitcoin, what's your recommended, how do you suggest people do that? Matt, we'll start with you.
Sure. There's no perfect way right now, right? If you're a small retail investor, you can use an app, but then you have some security risk on your phone. You're paying relatively high spreads. If you want to go through a brokerage account, you can buy something like GBTC, but then you get premiums and discounts. If you're willing to do sort of paperwork headache, you can go to a private placement like Bitwise or the funds that Ark and others manage. And if you want to wait until many of the gains have accrued, you can wait for there to be a Bitcoin ETF. The important thing is you just have to choose which of these slight imperfections best fits into your personal workflow. Is it the possible security risk and high spreads on the app? Is it the possible premium risk on some of the OTC traded products? Is it the paperwork risk, if you want to call it that, on the private placement side? And the answer will be different for everybody. But the important thing is just to start dipping your toes in the water, start educating yourself, and then evaluate all three major allocations and see what's best for you.
RIA, how would you suggest people get involved?
Yeah, I think one of the incredible things about the crypto space that really attracted me from day one was the fact that the research and content and education is so freely available. Just in the past 3 years, there's been so much improvement in the channels through which investors can get educated. I think all of us here have free resources on accessing Bitcoin and have dedicated researchers that are, taking client questions into account, asking clients what's confusing you, and are also, all of us are willing to answer any questions personally. But I think it starts with education that was emphasized by many of us on the panel today. Take the time to do the education. And in addition to some of the channels that Matt mentioned, I think another really interesting way to get exposure to Bitcoin is through some of the Bitcoin rewards platforms like Lolly and Fold, where you don't actually have to, make an upfront investment. You just earn Bitcoin rewards for daily activities, shopping on a variety of really popular retailers as well. So I think that's a great way to just dip your toes in as you're learning about the other different platforms and channels available to make a more upfront investment in Bitcoin.
And Sunanya, how would you suggest people get involved, or they want to get exposure?
Yeah, I like going after Matt and Ria because I could say ditto. I was talking to an advisor last week, in fact, and he's kind of going through his education process. And at one point, he paused and he's like, "Shoot, I feel like I'm late to the party. I missed the boat." I'm like, "Whoa, no, you haven't. Like, we're just getting started." So that would be the first thing I would say to people. Yes, there's a lot of enthusiasm and we've come a long way, but we are here when we look back, decades down the road. So it's never too late to get started. And I would just underscore what others have said. Education is the silver bullet. And, building on what Ria said, if you are somebody who's insatiably curious, and most advisors are, because they're juggling so many things, they're already multidisciplinary by DNA. This is such a perfect fit, because if you look at something like Bitcoin, it's a confluence of different things like economic theory and finance and technology and poli-sci. So if nothing else, if you're a lifelong learner, this is a great kind of rabbit hole to fall into. And in terms of on-ramps and instruments, it's getting better day by day, and there's more choices today than there were just a few years ago. And I think we'll continue to see that become more accessible and normalized.
Mm-hmm. And last but not least, Yassine. So how would you suggest people learn about Bitcoin, cryptocurrencies, and if they want to get exposure, how would you recommend?
Sure. Honestly, I think my fellow panelists expressed it quite perfectly. But I think that there may be a difference between, I would say, how a traditional retail investor might get exposure versus an institutional investor. If you are a retail investor, I think that there is tremendous value in actually learning how to custody your own private keys and figuring out and really participating in the Bitcoin network for everything it has to offer. But again, if you're an institutional investor, just like Matt said, there is no perfect solution. You can't self-custody. If you're a part of the sort of qualified custodian rule, and you have to follow that. Or you don't want to have it account for it on your own balance sheets because of the potential liabilities there, the operational load that you have to build out. So again, I think it's really a matter of start with education, as every panelist has mentioned. Learn why having exposure to something like this can be valuable. And then at this stage, there really is no perfect solution. So just know the trade-offs and sort of pick your poison. And then from there, start to sort of diversify in terms of how you get exposure. I think that's something that a lot of people, especially on the institutional side, don't fully recognize, that there are different mechanisms by which you can gain exposure. It's not just diversification of the assets themselves, it's also diversification of the product suite. And so that's something that I would urge investors to also take a look at.
Great. So congratulations, you guys all did a great job. Patrick, you still out there?
Hey, Brian.
Okay. So I'm gonna throw
I'll
it
take
back
it from,
to you.
thank you. That was a lot to pack into 60 minutes. So thank you, Brian. Fantastic job moderating. And that's a really tough office background to beat on your end.
Well, and this is my first time moderating, so I was a little nervous. So.
Yeah.
You've got a future in front of you in case this fund management thing doesn't work out. Sunania, Christine, Matt, Yassine, thank you for joining us today and sharing your insights. I'm hopeful that our audience found that conversation as stimulating as I did. We'll be making this recording available as an on-demand resource after today's event. Really appreciate everyone bearing with us with some technical difficulties there and half the audience getting back into the room. Be on the lookout for an email from us that contains the recording link here, along with several recommended reading resources that the speakers here have provided. Thanks for spending the hour with us. We hope to see you during our next two events in this series on October 22nd and the 29th. My colleague Jonathan will post the links here in the chat. And then again, if you're interested in learning more about the Chamber, I'd love to hear from you. I'm Patrick at digitalchamber.org. I hope everyone has a great rest of your day. And speakers, again, thank you.